Welcome, guys, to another episode of the WealthWise Show. I'm your host, the Wise Investor, and today we're going to embark on another WealthWise journey and into personal finance. And today's episode is going to be about the Fed rate decision that they just did a couple of days ago, as well as I'm going to talk about a nice strategy to help make sure that your portfolio can still maintain its value as at the same time produce some income. So with that being said, today get some housekeeping out of the way. Guys, understand that this episode and this podcast and me, I don't give out personal investment advice unless you're a client. This is for educational purposes only. So anything I say, any companies I mention, please do your own research and confirming that this is something that's good for you, or talk with your own professional, finance professional, determine if this is good for your portfolio or not. So once again, educational purposes only. That this podcast, my opinions are that of my own, and does not reflect the opinions of Simplicity Wealth or any of my clients at all. So with that being said, let's get into today's show. So first off, if you're listening to this on the podcast streaming services like Spotify, Apple Podcasts, or what have you, you're probably not, just sounds normal, regular. But if you're watching this on YouTube, if you're like actually on youtube.com and you're following us at the WealthWise Show, you will notice that I look a little more clearer. And, you don't see my name down there. You don't see a timestamp. And that is because hopefully this new setup that I've just made up is hopefully it works. So I am using a camera, an actual standalone camera, not just a webcam. I am continuing to use my microphone and have a ring light that you can see my glasses. So hopefully this is going to be the future of the WealthWise Show. And then we're just going to continue to get better and better as time goes on. So I'm excited, and hopefully this is a bump up in quality that I've promised. And yeah, guys, tell me what you think. Comment, like, subscribe. And so with that being said, let's talk about the federal funds rate. Now, if you've been rocking with me for a little bit, then you should know what the federal fund rate is by now. You should know why it's important. What does that mean for you and your personal finances? What does that mean for you and your personal investments, etc.? And I think it was yesterday, actually. Yeah, yesterday, January 31st. So I'm recording this on a Thursday, the 1st of February. And the Feds decided to hold rates. What does that mean? That basically means that they are not increasing the rates, but they're also not decreasing the rates. Remember what I said, how they utilize interest rates to kind of help with the money supply? I said that a few weeks ago. Well, this is still their goal. Their goal is to get price stability with maximum employment. And we talked about that last week and the week prior. But what does that mean for you? What does that mean for me? What does that mean for the economy at a whole? The same thing. They're just waiting to see. Remember what I said, that report that came out in last month in January for December's CPI data. I said, hey, just because it had a bump up doesn't mean that the Feds are going to make a decision, because like Jerome Powell, the Fed chair, like he said, 6 months of data is not enough. They want to see trending. So I'm in the same camp, wait and see. And I know that approach, means that the tightening, people are feeling that day by day. It's not like 6 months of high interest rates can be a extreme burden on a lot of people. But their job is, like I said, price stability, which is getting inflation under control, as well as maximum employment, meaning making sure everyday folks have jobs so they can put food on the table. And so, unfortunately, moving too fast or moving too slow, as we've seen in 2020 and 2021, that, that could be devastating for the overall economy. So if they, want to wait, which they're currently doing, and see, that approach, we should take that and be like, okay, now I know a lot of people say, well, they need to go ahead and start cutting. But one of the things that what could happen if you cut too fast, if you start cutting too early, is inflation starts to creep up again. Because even though home prices hasn't really been going down, even though a lot of other prices have been slowing down, people are still out there spending. So if they start to cut the rates, and let's say they cut them in March, he already said that they're more likely not going to cut rates in March. But let's just say they do. What could potentially happen? Well, if they start cutting rates in March, all this money that people are already been pent up, they've already, ready to spend it, ready to buy, that's just going to flood the market with more cash. And then what's going to happen? More cash in the system means, well, remember what I talked about inflation, how it works? If you have an influx of demand, but not enough supply, then prices go up. And he already said before that, the supply chain, even though that is getting better, is still not at 100% yet. So, those who are wishing to go ahead and cut so they can, start making more money, their job is not to make the institutions more money. Their job is not to think about only the big guys. Their job is thinking about the everyday person who, work for these particular companies. And it's a catch-22, because if these big companies hire you, like, mirror you, and they don't have enough money to keep you on board because, rates are higher and borrowing money costs more, and, more things are coming up, well, they're going to have to start cutting their head count. And that means laying off people, which we've been seeing in, the past couple of months. Different corporations have been laying off people left and right. So it's a tough decision, tough job. I don't want it. Don't wish, on my worst enemy, because you're determining, what affects the big people affects the small people, unfortunately. So that's one of the things where, I'm going to keep track on. I'm going to keep looking at determining like the data that comes out. Unemployment data came out today. Let me pull that up. Unemployment came out today, and it's a little bit higher. So what that means is, a few more people than expected have claimed unemployment this past week. So, you're in a direction to where, technically people are starting to, lose employment. But there are other factors in play where when it comes down to employment, because there's other, like, a lot of tech companies. I think UPS came out and said that they're laying off people too. But they can find jobs other places. So they may claim unemployment now until they find another job. So it doesn't mean, they're going to be out a job forever or for months. Hopefully that's not the case. But, so when you're looking at unemployment claims, that's an important report to look at. But I have to understand, like, hey, if I got unemployed, of course I'm going to file for unemployment because, and while I find another job, I need to have some sort of income. And, I can find a job next week and then come off of unemployment. I can find a job next month and come off of unemployment. So that's more of a fluid report for me personally. So my main thing is looking at non-farm payroll, meaning, we talked, I think we talked about non-farm payroll. If we did, my apologies. I'm like 80% sure, I'm 90% sure that we talked about non-farm payroll before. But that's a more important report for me because, yes, unemployment to me is temporary. It's meant to be temporary. But non-farm payroll, that's people getting jobs. So that's going to be a more important data point for me to watch, as well as CPI. CPI this month is coming out on the 13th. So on the 13th, I'm going to be looking at those numbers to determine, are there going to be rate cuts this year? And I'm going to say this year, not because I'm in the camp of rate cuts at the end of the year, because they said that last time and it makes sense to get some more data in, maybe a year worth of data, maybe a year and some change worth of data before, to see if it's really trending in the right direction. And then PPI. Now that is I know for a fact, I don't think we talked about PPI before. That might be another episode. But those are the things I'm looking at: non-farm payroll, PPI, and CPI. And what that means for you guys at home, understand that a lot of people are trying to make sure there is not a recession. And so, that's one of the things that they're trying not to do. And so far, they're doing a pretty good job at it. And it's a very tough job. So, I wouldn't get mad at one particular person because things are not going the way, you may expect. Just understand it is a tough job. And, understand that, these people are literally doing their best. They're focusing on making sure that you, I, and your neighbors have jobs, while at the same time making sure we're not overspending on eggs, milk, and cheese. So that's going to be it for the Fed Talk. That might be a segment, Fed Talk. You heard it here first, guys. And so next, going to get into the meat of the episode. I know I'm 12 minutes in, and that was just the appetizer. I want to talk about back to basics, I guess, where I talk about different tools, different things that can potentially help you with your personal finance, with your investing. Now, I'm always going to be in the camp of using a professional because I am a professional. So I'm going to say, hey, if you want, talk to a financial advisor to help you make these decisions. But I also know when you're younger, having a financial advisor might not be feasible. One, because you might not have enough investable assets for them, or you might not want to pay that hourly fee, depending on, their fee structure. So if you're in the camp of, hey, I really want to do this on my own because, I literally have no other choice, this strategy could be helpful for you. Alrighty, guys. So I know that was a word cut, and it was definitely a cut because I was trying to explain what I'm about to talk about, which is cover calls, and it got too convoluted, way too convoluted. I felt like compliance will not be so happy with some of the things I said, so I decided just to cut it out and make it simpler and restart it. So I am going to talk about cover calls and options. I know I haven't talked about options a lot, which is something I'm going to, try to rectify. And I know I haven't talked about cover calls a lot, or calls or puts. So one of the things I wanted to really talk about in this particular instance is cover calls. Now, if you don't know what options are, if you don't know what calls or puts are, I will explain that in a later video. But you can always go to investopedia.com, not a sponsor, and look up options. Just type in options and it should give you the definitions of what those things mean. But for those of you who know and understand what options are, options can be a beautiful way to make income. And I'm not going to leave you guys who don't know hanging, so I'll give you a little bit. Options are basically contracts that can help you make income. They're contracts to help you buy shares of companies. So they're options to purchase these things. Think of it like wholesaling. If you are ever heard of wholesaling, to where you have a contract of a house, you don't own the house yet, but you have the contract to buy the house at a certain price at a certain time. Options are very similar to that. And if you own shares, you can use options to produce income especially when the markets are at all-time highs. So that's why I'm bringing it up, because the markets are at an all-time high right now, currently. And one of the things that I like to do in my own personal finance, and I haven't done this in a while, but this is something I used to like to do. I just haven't had time for it. Is using covered calls to produce income when the markets are high, or if I feel like hey, we might retrace a little bit. And what retracing means is, if let's say it goes up and then it, retraces back down. So what are covered calls? So reading the definition, covered call is a options trading strategy in which the trader sells a call option while also owning the underlying security. So what does that mean? That means, let's say you own 100 shares of a company. I'm not going to mention any companies. I made that mistake in the last portion that was cut out. Let's say you own 100 shares of a company or a asset, ETF, doesn't matter, and you want to produce income. Well, you can have 100 of those shares, and you can create or write a call option to sell those 100 shares at a given price at a given time. So how it works is, one, you have to own the shares. It's not like you can just, you technically you can, but that's not what we're talking about today. You have to own the shares to do covered call options. And how it works is, like I said, it's a contract. So you are the person with the 100 shares. You say, hey, I would like to sell 100 of my shares. Let's say the stock is at $100. And you feel like, hey, if the stock gets to $150, I will sell 100 of my shares for $150 if it's more than that. So you say, hey, I have 100 shares. I write this contract for the strike price is going to be 150. And if the underlying asset or if the stock gets to 150, or let's say 151, 155, then I would still sell my shares at $150. Now, why is that beneficial? You might say, well, Derek, the key is to keep my shares. You're right. But let's say the market's at all-time high, or your assets at all-time high, and you feel like, hey, this, it's great. And we've been running, the market's been running for the last couple of months, and it's been, 20%. I just want a little protection at the same time produce some income. Well, then I will write a call option for, $50 more. I'm saying don't write it for $50 more. I'm just giving you an example. $50 more. And if it gets there, great. I get an additional $50 a share. And the premium, which is the value of the contract, you keep. So you remember, you're selling the contract. So you have 100 shares. You write the contract. You sell the contract for the premium. It could be, $100, it could be $50, it could be $200, depending on the asset. And once you sell it for, $200, that's the big part. If the asset gets to that price that you say you will sell at, and it becomes more than that price that you say you will sell at, then you will sell your shares for the price, and you keep the money that you sold the shares for, and you keep the premium that the contract sold for. Now, what if it doesn't get to that price? What happens then? So let's say I'll sell these 100 shares for $150. And right now the current price of this stock is $100. And it gets to $120 by the time the contract date that you designated is $120. Well, the contract expires worthless, meaning the money that you got from the sale of that contract, you keep 100% off, and you keep your shares. So that's how, that strategy typically works. You don't typically want to sell your shares. You'll want just to produce the income from it. So if hey, I want to do this to write call options. That way I can produce an income. There is a little bit more due diligence when it comes down to doing that. So you have to know your stuff. And typically, if you have an advisor or someone who, invests for you, this is a strategy that they can utilize for you. You can say, hey, Mr. Advisor, I would like you to implement a cover call option strategy to produce some income. And then, they will implement that strategy. But if you want to do it on your own, these are the requirements. You have to have 100 shares. And that's it. Have 100 shares, and, you can write call options on them. And now you don't have to have only 100 shares, meaning, if I have 1,000 shares, that means I can't do it. No. One contract will be 100 shares that, you'll be putting up to giving someone the option to buy from you. And so if you have 1,000, that means you can do 10 contracts. But, typically you don't want to do all of them. You don't want to do, if you have 1,000 shares, unless you want to get rid of them. Unless you want to get rid of 1,000 shares. I don't know your life. I don't know you personally. Calm down. Typically, you don't want to put all of them up for sale if you actually want the shares, because just in case you do have to have them sold, and it's not something that it is a contract. So let's say it gets, to that strike price, or it gets to the price you designated and is over that, and the person who bought the contract says, hey, I want those shares. There's nothing you can do. You have to sell them the shares. But at least you get the profit plus the premium for the contract. So I am going to explain this in greater detail. Not just covered call options, but, the whole option thing. And it can become complicated, and it will become complicated. So I'm going to implore you to go out and look up what you can if you're interested. Don't do it just because, only if you're interested. If you're not interested, don't worry about it. But go out and look up options. Investopedia is my best friend, and it can be your best friend too. YouTube is also my best friend. It can be your best friend as well. And look up what the different options. So if you want to, you got options, you got put options, call options, and then you have the strategies that go along with them. Me personally, for the next probably 2 to 3 weeks, I'm going to talk about, the basics of what an option contract is. What is a put contract? What is a call contract? And then the simple strategies of cover calls and then cash secure puts, and why they're important to know if you are an investor. So I'm not going to be telling you, hey, buy this. I know there's tons of people out there who be like, hey, buy this option, do this, do that. Now, this is just strictly definitions, and what they mean. They're not meant to entice you to go trade. They're not meant to entice you to go buy these things or do these strategies. They're just giving you more information so that way you can make a WealthWise decision in your personal finance. So that's going to be it, guys. Hopefully this made some sense. I'm not going to lie to you, it was a little tough because options can become complicated, and trying to explain it to someone who have no idea what you're talking about, takes a lot of time to understand how to do that. And so I'm going to go back to the drawing board. Hopefully you understand a little bit. And, the next couple of episodes, I'm going to really try to explain what options are. So that's going to be it. I said that already. I appreciate you guys rocking with me for, I think this is the 40th episode. So I greatly appreciate it. If you are listening to this on Spotify or whatever, rate, leave a comment. I greatly appreciate that. Share with your friends and family. If you're watching this on YouTube, like, comment, subscribe. Please subscribe and like. I heard that helps. And that's it. So until next time, guys, stay WealthWise.